All right, everyone, welcome. So today we're going to move beyond just the nuts and bolts of accounting, beyond debits and credits, and step right into the boardroom. We're going to explore how the numbers you see on a balance sheet, well, they aren't just for keeping score. They are incredibly powerful tools that actually shape the strategic direction and really the entire future of a business. This is where accounting stops being about record keeping and truly becomes the language of leadership.
To really get a feel for the power of financial accounting, let's not start with a dry textbook definition. Let's start with a problem, a high-stakes problem. This is a scenario that I guarantee many of you, as you become the business leaders of tomorrow, will almost certainly face in some form.
Okay, so I want you to put yourselves in the shoes of a CEO. Your company is doing great, it's growing, and demand for your product is just going through the roof. Now, to meet that demand, to really secure your place in the market for the next 20, 30 years, you need a massive injection of capital. And we're not talking small change here. We're talking $1 billion for a brand new, state-of-the-art production facility. The big question is, where does that money come from?
Now, the answer to that question, it's not just about finding the cheapest loan you can get. This is so much more than a simple transaction. The financing path you decide to take will create ripples that affect your company for decades to come. It's going to dictate your obligations, it's going to influence every future investment decision, and ultimately, it will define your strategic freedom. This isn't just a financial decision, it's a legacy decision.
So where do you even begin? As a leader, how do you tackle a decision this big? Well, the very first step is to look inward, to read your own company's financial story. You have to understand your current financial structure, what obligations you already have on the books, and what your actual capacity is to take on new ones. And the answers, they're waiting for you in the balance sheet.
And this is what brings us to our core concept for today, non-current liabilities. Now, the textbook definition tells us these are obligations that are not due for settlement within 1 year. Okay, but what does that really mean? In the business world, 1 year is generally considered an operating cycle. So what we're really talking about are long-term commitments. These are the financial promises that form the very foundation, the bedrock of a company's capital structure. There's a quote from our source material that really hits the nail on the head. Because evaluating these long-term obligations, this isn't just an exercise for accountants or for auditors. For a leader, for a CEO, it's about gauging your company's stability, its ability to weather a storm, and its potential for future growth. Think about it. A heavy burden of long-term debt could mean there's less cash available for R&D, for marketing, or for surviving an unexpected recession. It's a huge deal. Okay, so we know what they are. We know why they're so important. Now let's get practical. Let's open up the financing toolkit. What are the actual options available to our CEO as they try to figure out how to fund that billion-dollar factory? So the two main players here are long-term loans and bonds payable. Let's really break this down because they are fundamentally different. With a long-term loan, you're going to a single institution, like a big bank. You're building a direct private relationship. That allows for negotiation, maybe you can get more flexible, tailored terms. But, and this is a big but, that bank is going to impose very strict conditions on you. We call these covenants. Think of them as rules to protect the bank's money. For example, they might require you to maintain a certain debt-to-equity ratio. If you break that rule, you could be in default. Now, on the other hand, if you issue bonds, you're borrowing smaller amounts of money from thousands of different investors on the public market. The terms are rigid, they're set in stone right at the beginning, but the real difference is the scrutiny. A bank loan involves a private financial review. The bond market, that involves public credit ratings and the constant watchful eye of the entire investment community. Two very different worlds. Now, it's really, really important to remember that these financing decisions don't happen in a vacuum. A company has other long-term promises it has already made, things like pension obligations, which is a sacred promise to your employees for their retirement, or deferred tax liabilities. These represent existing claims on your company's future cash flow. Now, you can't use these to fund the factory, of course, but they absolutely impact your capacity to take on new debt. A true leader has to see the complete picture of all the company's long-term promises, not just the new ones they're excited about making. All right, so we've got the theory down. Let's step out of the textbook and back into that boardroom. We have our financing tools, and we understand the obligations we already have. It's time to apply this knowledge and make a reasoned, strategic choice for our billion-dollar factory. Okay, team, let's walk through this. Look at our decision matrix. First up, cost of capital. A loan often comes with a variable rate. That might be cheaper right now, but what happens if interest rates shoot up in 5 years? That's a massive risk. A bond, on the other hand, offers a fixed interest rate. We would know exactly what our interest cost is for the next 20 years. That predictability, that's very, very attractive. Now let's talk covenants. The loan has these strict rules about our debt ratios. That could really tie our hands and prevent us from, say, making an acquisition a few years from now. The bonds, they're usually less restrictive, which means more strategic freedom for us. And the repayment structure, completely different. The loan requires us to pay back principal and interest every single quarter. That's a steady drain on our cash flow. With the bonds, we just pay the interest along the way, and then the entire $1 billion is due at the very end. That's a huge bullet payment we'd have to prepare for. And finally, what's the market signal? Securing a huge loan from a major bank signals a strong, trusted relationship. But successfully issuing $1 billion in bonds, that signals that the entire public market has confidence in our future. As you can see, there's no easy answer here. It's all about strategic trade-offs.
And this brings me to a really critical point, and frankly, it's a mistake I see students make all the time in their analysis. It is so easy to just run the numbers, do a quantitative analysis, and pick whichever option has the lowest interest rate. But as we just walked through, the cheapest option isn't always the best option. Those strategic constraints from covenants, or the major cash flow impact of a repayment schedule, in the long run, those can be far more costly than an extra 1/4 percentage point on the interest rate. So the key takeaway here is this: you must analyze the qualitative factors right alongside the quantitative ones.
So let's pull all these threads together. What does this all mean for you? You know, the whole point of this exercise, of this deep dive, is to show you that understanding non-current liabilities isn't just about passing your next accounting exam. It's about developing the mindset you need for strategic leadership. What I want to give you here is a simple 3-step framework, a kind of mindset you can take with you into any big decision. First, always start with the why. What is the strategic goal you're trying to achieve? Is it pure growth? Is it stability? Innovation? Second, assess your tools. Which financing structure, a loan, a bond, something else, best aligns with that specific goal? And third, and this is crucial, always evaluate the long-term impact. How will this choice affect your company's financial health and its strategic freedom 5, 10, even 20 years down the road?
Look, if there's just one thing you remember from our time together today, please let it be this. A liability is not just a passive number that an accountant records on a balance sheet. It is an active, strategic commitment. Every single long-term obligation you take on is a promise that will define what your company can and cannot do for years to come. In this sense, accounting really is the language of business strategy.
So I'm going to leave you with a final question to chew on. We tend to think of liabilities as a burden, right? A weight on the company. But if you look at it through the lens of our factory example, that $1 billion bond isn't just a debt. It's the very tool that makes a brighter future possible. So the question becomes, at what point does a liability stop being a debt and start being a strategic investment? Thinking through that question, well, that's the kind of thinking that separates a bookkeeper from a CEO.